And timing sometimes is just perfect. So many of you, or some of you, may have noticed what happened to gold today. And this is perfect because it's exactly what I want to talk about, is why this happened to gold today. For those that haven't looked, the spot gold market, so Wall Street's gold market, declined by about 42 bucks. Now, they're going to use a whole bunch of different reasons for that. One of them is that Janet Yellen may raise interest rates. That's ridiculous. The reason, in my opinion, this is my opinion, I can't prove it, but the reason why you saw gold whack today was simply because over the weekend, we had a global financial system shift, which is what we're going to talk about today. And what I've found in all of my research that I've done is that there are a couple things that they want to have happen when there's a major shift. Number one, they don't want you to know about it. So they want things to appear as normal as possible so that you have no idea what just happened. And then number two, they want to have some distance between the shift and when you do know about it. So, having said that, I did some calculations today because those that have been to more of the webinars know that the E-mini futures, which is what we're looking at right here at the CME, costs the central bank and their minions $1.10 to control 100 ounces of physical gold. So prior to the market's opening at 9:20, between 9:20 and 9:25, as you can see, there were over 24,314 futures contracts that were sold. That's that big spike that you see right there. So it cost them $26,745.40 to whack gold like that, as you see right there. Now, considering the fact that you and I would have to earn that $24,000, but all they have to do is push a button, that makes it even cheaper. So that $24,000 actually controlled over 2.431 million ounces of gold, and it cost at a dollar cost to spot at over $3 billion. 26,000 to control 3 billion. It's good to be king, okay? Now, for all of these spikes, so this spike, this spike, this spike, and that spike, they sold short, this is gold that they don't have, it's just on a computer, over 74 million ounces of gold. That is pretty close to the entire world production of gold up until this point. At the same time, look at demand, okay? There are 542 owners for every available ounce of gold for delivery at the COMEX exchange. Talk about leverage. And this is what the central banks have been doing. That's a full year. I didn't have 2016 full year. But they're still on target to be buying gold. So if you stop and think about it, in a real free market, what you have is when demand exceeds supply, prices go up. When supply exceeds demand, that's when prices go down. But the other thing I want you to understand is if you actually owned that much gold and you wanted to liquidate, are you going to sell it all at once so you get the worst price? Or are you going to decide how you're going to liquidate it so that you don't hurt the price that you get? So, perfect day to show you what market manipulation looks like. Now, I haven't looked at the other contracts, but the E-minis are the ones that I know that the central banks like to use, so I just went right there. Okay, now